following is a presentation of TFNN. The Tom O'Brien Show is produced every business day. Tom takes your phone calls toll free at 1-877-927-6648. Internationally at 727-445-1044.
Let's go to Marty in Worcester, Mass. Hey, Marty, what's going on?
Hi, Mr. O'Brien. Got a quick little thing here.
Yeah?
It's called patience and perseverance.
Okay.
Patience. I heard a goddess yelling the magic silent word, and methinks I must be smelling pokey money round the world. Perseverance. When markets roil like stormy seas, good traders seek safe port. In financial times like these, you need Tom O'Brien's gold report.
You are too much, Marty, man. That is so cool. Well, listen, man, I really appreciate that.
Now, Tom O'Brien.
Welcome, folks. This is Tom O'Brien of TFNN. We go 5 days a week. We go 10 hours a day. We go 24 hours a day on the internet at TFNN.com. Always remember, folks, whatever you think about, you bring about. Whatever you focus on grows. Hope everyone's having a great day, safe day. Let's make it a great night, folks. This quote by James Garner: believe in yourself and everything you can be. Yesterday's gone. Tomorrow's not here. What are you doing right now? Market-wise, let's take a look at it out here. We have the Dow Industrials up 258 points. NASDAQ's up 70. S&Ps are up 26. Gold contract up $8.20, traded at $1,185 an ounce. Silver up 13 cents at $15.97 an ounce. Platinum up 7 at $1,114 an ounce. Light sweet crude up $1 at $61.65 a barrel. Bonds, we have the 10-year down 15 ticks, 124.20. 30-year off a full point and 8 ticks at 147.28. King dollar down 532 ticks, trading at 94.64. The euro is up 35 at 113, and the yen is down 1.6 at 122.70. Our phone number is 877-927-6648. Give us a call, folks. Want to know what's going on in your world? In the world of the S&Ps, let's take a look at them. What do you have out here? Okay, you got a bounce going. The bounce is with 95 million shares thus far, and you're going into 124 million. So the bottom line, I expect we'll do about 105 million shares. That's in the SPY. On the NYSE, folks, this bounce is anemic volume. We're at 475 right now. That'll say that comes in at about 650. That's how I suspect this is going to happen. We'll stay at the S&P for a second. So, coming into the next hour, what you're going to have is this. So, what we had out here this morning is this. You had the market first off, moving top side. You had Angela Merkel come out from Germany saying, guess what? We are considering throwing Greece a lifeline. Bottom line, you know, I talked about it yesterday. The bottom line, they have to do it, period. It's not even close. This is a dead cat bounce, folks. This is a fast bounce, and that's what you get with markets that want to go downtown. So this is going to be wild watching this whole thing shake out. It's particularly going to be wild just coming into the close right now, because you've had zero sellers from the price point, the spike higher. The spike higher was 1110 this morning. That's where the S&P itself, the future S&P, and that's right when Germany was closing, so they waited till that was closing. That's where it spiked from 98 to 2108. You know, so we had 10 S&P points spike up there. Now, if we look at this, this is what's there's been zero sell-off from that spike this morning. You had one little downdraft that took it into 03. Bottom line, we'll see whether we get down into this 2101 area. I expect you're going to see that. Now, what's going to be intriguing is that if it actually comes into the 98 area, you know, we'll see. There's been zero sellers from that price point on. The NQs, we take a look at the NDX 100. What we have with the NDX 100 is this. The 3 Qs right now are trading at a price point of 109.70. Thus far, we've done 21 million shares. That 21 million is going into, let's see, we've hit 109.81. Yeah, you're going into 30 million. You know, so I suspect what you're going to see inside the 3 Qs also is that you're going to see a slight sell-off into the close. The bottom line is that, so when we look at this, if you don't have a slight sell-off into the close, what you'll get is that you're going to get another run for the top of the market. You know, because in the Qs, we're only at, we're at 109.70. 111.80 is the last swing point. The actual high up there is 111.16. What I expect you're going to see, though, is this. And it doesn't have to sell off a huge amount. The Q's only got to sell off 33 cents because then you'd have a failure of only 2 days ago. That's how this thing shakes out. Actually, and the larger failure would go like this. If we sold off, we're at 109.69. If you close under 109.21, that would be the number, because what that is where we came down on the 4th of June. So that's how this baby shakes out, and I expect you're going to see some selling into the close, but we'll see if that does get generated. We're going to take a look at the small caps, the IWM. IWM out here. Now, the IWM, the Russell itself, is the only indice that hasn't got into the highs. And guess what? You're going to have a failure out here today, which is just a mind blower, because the IWM is trading at 126.13. And, well, actually, it would have to close under 125.93. So we'll see whether that's what we get. The IWM, the high that was generated in the IWM goes all the way back to the 15th of April. 15th of April, that was 127.13. Bottom line is that with a market that is up on the type of price that we're up today, because you're up huge prices, that baby should be able to hold. I don't think it's going to hold, okay? So the high volatility is here to stay, folks. Gold, what do we have with the gold market? We have with the gold market is this. Gold had price spread out here today. We are trading at a price point of 1185. We've done 113,000 contracts. That number right there is, we're 1185. Yeah, listen, 1185 puts it in the higher range. You know, we made it inside the range itself as it attacked the low on June 5th, okay? It came down. They couldn't smack it down. That was last Friday. They couldn't take it down. Let's see. Friday, Monday, Tuesday, Wednesday. Yeah, that's right. They took it down last Friday. Couldn't get it into the low. That was what was stopping it was the March 18th day of strength. Now what you have, you're in the larger range, and that's saying, hey, guess what? That wants higher price. What we don't have, and this is what's really intriguing, there's no doubt, you still don't have buyers. The metals look good. The equities themselves, bottom line is that some of these equities, with the gold up that far, still are not basically performing well. The TLT, the 20-year plus bond fund, that baby continues lower. This is going to be a vicious bond market, folks. I mean vicious. Now, that vicious bond market is going to continue to put selling strength inside the marketplaces themselves, because bonds are going to basically, the amount of money lost on bonds, folks, is going to be incredible. It's fast, it's furious, it's all the above. And the market itself, by the way, is pricing the yields up. You know, right now, if we take a look at the 10-year, the 10-year is trading at 2.484. On a percentage basis, that baby has gone up 20% in the last month and a half. What does that do to mortgages? That takes mortgages 30 years at about 4.1, 4.2. So bottom line is that if you need a mortgage, get out there, get it right now. King Dollar. What do we have with King Dollar? Bottom line, King Dollar is just really wild. King Dollar continues to lower price, and that is with yields going higher. King Dollar right now, we've done 77,000 contracts today. King Dollar has taken out a very small B point of an ABC structure on the way down. The larger ABC structure on the way down. Right now, we're at 94.67. We've done 77,000 contracts. The B point, the larger ABC down, off the high, is 93.17. I expect, number one, you're going to hit it, and the way the dollar's trading, it looks like it's going to blow it away. The B point, we only need 54,000 contracts. You break that, you're at 91 in the dollar index. And what is that going to do? Well, what that's going to do, that'll put firepower, no doubt, under the commodity market. Our phone number is 877-927-6648. We take a look at some of the high-volume stocks in this low-volume market. This is what you have. We have Bank of America up 25 cents. You have Microsoft up $1. Facebook's up $1.74. Inside the Dow Industrials, we'll tell you what is the leaders versus the weakness. And there's not one stock inside the Dow that is red right now. Visa is the leader out there, pushing it higher. That's up 164. The weakest stock inside the Dow right now is Verizon. That's still up 2 pennies. This is Tom O'Brien. This is TFNN. You stay right there, folks. We'll be coming right back. Dow Industrials are up 247. Nasdaq's up 67. S&Ps are up, where is she? 25. We're going to be right back, folks.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, Nasdaq, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. TFNN.com. Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Welcome back, folks. We have the Dow Industrials right now. Dow's down 250. You get the Dow is up 250. The Nasdaq's up 69. S&Ps are up 25. And let's right now go over to our man, Mr. Daryl Martin. Folks, Daryl has an outstanding show right here at TFNN. Also has a great scanner. Now, he specializes in the Nadex platform. You can come over to our website at TFNN. You'll see the banner on the top, on the side. You can hit that banner. Bring up the exchange. They'll put $25,000 of paper money into your account. Daryl and I and my son Tom also do a great show on Friday mornings, 10 to 11 Eastern Standard Time. You can check that out. Daryl does a great show on Wednesdays and Thursdays, 12 to 1. Now, all that programming, folks, you can get right on your cell phone, tfnn.mobi. Daryl Martin, what's going on?
How's it going, man? It's been a monster run up today, hasn't it?
It's a monster run up, and this is where, folks, when we talk about defined risk, well, defined risk, bottom line, I happen to be in the wrong side of the market inside that NASDAQ, but guess what? Defined risk is defined risk, folks. And defined risk means that you lose what you put up. And, you know, on a day like today, thank God for small miracles and big miracles, because what you had inside those NQs, folks, is that when the spike came, the spike was a 20-point spike, which is a lot of bread. If you were in the futures market, it
was huge, because when that news came out at like at 11, it hit that first spike and then just kept going. So.
Exactly, and the spike itself. So we're talking about that spike. It was a 19-point spike. You know, bottom line, that's a big number. But that's where, when we talk about defined risk, that's a whole different ball game. You know, you don't. On the defined risk type of situation like that, too, what happens is this, folks. Let's say that it went the other way, meaning it went where I wanted it to go. Well, what would end up happening there is that, yeah, you wouldn't have got the whole all the way down, but guess what? That's what that defined risk is all about. Do you know what I mean? So, needless to say, the last few days have been great. Today wasn't great.
Yeah, that was just a pop. I mean, I read stuff last night that they were working on it, and they may have something, and today they surprised the market. I mean, you're just ready for explosive moves one way or the other whenever the whole Greece thing comes up.
Right, so and I mean, yesterday, I didn't even know that they were working on anything. But the bottom line is that Greece cannot let Merkel come out today and said, hey, listen, they're going to give them the life. They have to give them a lifeline. They don't have a choice. You know, Greece is playing hardball. They have to give them a lifeline. The euro's blown up. And what it is, though, this is, when you cut to the chase, folks, it's the German banks that are on the hook. The German banks are the ones that gave Greece all the money, you know, so they're the ones that are on the hook. Deutsche Bank is on the hook for like so many billions, it's insane. So
right, if they don't give them a life, they're like, all right, fine, we'll just file bankruptcy and say see you later. Now you're off.
Yeah, they don't. So watch how the lifeline goes too. The lifeline, folks, is only to pay the interest back to the banks. That's how this thing shakes out, you know. So
yeah.
Bottom line, though, you know, volatility in the marketplace, yes, big time. And volatility, by the way, folks, is still a trader's best friend. There's no two ways about that. You know, what is going to be intriguing here is that the market gave it all right at that 11 o'clock and hasn't done a thing since then. So we'll see if, in fact, the market wants to do anything coming into the coming in the last 20 minutes. You know,
and they extended it to them. They gave them the lifeline. They raised their credit limit, all that fun stuff.
Sure.
But I mean, they still have to pay it.
Yeah. Right. No doubt.
You know, which they missed their first payments. Like there hasn't been a payment missed to like I don't know, whatever it is, but whatever body they choose now to label it under. But it's like the 80s. So they missed their first payment on the 5th. And they're saying, well, give us more credit and let us take all the payments for the month and put them into the payment at the end of the month.
Right. And
well, if they couldn't make that one payment for that one, why are they going to be able to like do all 4 payments at the end of the month?
Because so watch what Daryl's talking about, folks.
Yeah.
So you have 2 different payment systems here. One is to the IMF, and the other is going to be to the European Central Bank. And they were smart, because what they did is that the payment on the 5th was to the IMF, and they said, guess what? You know, we're not going to pay that to the end of the month. Because, so right off the bat, they were already explaining to them, hey, guess what? If you don't make the deal with us, the IMF, you're not getting any money either. Well, that's the same banks. Now, the difference with the IMF is that we're one of the largest funders of the IMF, okay? So, meaning the U.S. But they were smart, man. That's the bottom line. So, seriously.
Like, we just don't make this payment, and then they don't get paid, and then all the pressure comes on, so you better do something, or
that's right.
The cookie's going to crumble.
Oh, you're all not going to get paid, you know?
Yeah. And they're like, you know what? We think we can deal with this. Can you? I mean, that's sort of the stand they took.
Yeah. Oh,
you know, we're willing to go there. Are you willing to go there?
Exactly. Exactly.
And I mean, they called the bluff by just not sending the check.
They did. So. And this is the classic, folks, is that, you know, you've heard the saying before, when you owe the bank more than they can handle, guess what? You own the bank. When you just owe the bank like normally all of us do, okay, they own us. It's so simple, right?
Yeah.
I mean, it really is. You know what I mean? And it's that cut and dried, you know? So listen, when you're, you know, when we're taking a look at the Nadex platform, right? I know you like to do, you know, a couple other sophisticated trades. Now, what would that be like today on that platform?
Today, if I was doing something like an iron condor, I haven't done iron condors this week.
Okay.
So basically, because the IV was, I did like a couple like shorter term ones, but I closed them out before certain announcements came out.
Yeah.
But like my main big iron condors, like I backed off on, because I put them on and then I gave a lot of them up hedging with the binaries.
Yes.
And then I just started trading directionally, because when we started getting these big swings, I just go directionally with them.
Yeah.
I expected volatility, but whenever we saw that IV coming up about 2 weeks ago, IV just started creeping up.
Yeah.
You know, and it's getting higher and higher and higher. Volatility was decent, but it wasn't just massive, okay? And so there's some expectation coming up, which it was this grease payment. We found out. You know, a lot of times we don't figure out until after the fact.
Yes.
And but then I saw the news on Friday that, hey, you know, they missed their payment, and they're calling emergency meetings, and they're trying to solve all the stuff this weekend and all that. And I'm like, it's funny because I saw people going, hey, there's G7 summits, you know, all this, don't trade, it'll be choppy. And I'm like, no. With that grease thing, it's going to be an awesome freaking week to trade. Yeah. And so that's not the week I normally want to go in on my neutral trading strategies.
Okay.
Or if I do, I'm going to like a more sophisticated, like what I did on, you know, Monday. I go in, I buy a lower spread, sell an upper spread, basically an iron condor. Yes. And I mean, you could get like $200 in premium for it. Okay.
Well, I guess it's going to be really cool now, right? Because you get that, you get the explosion topside, right? Yeah.
Exactly.
Right.
And then what you do is you take that premium and then you go in and you buy cheap out of the money binaries with it.
Yes.
Okay. So you're buying like 5, 10, at most $20 binaries, and maybe even a little bit like a 20, a 15, you know, and like a 5, a 20, 10, and a 5.
And folks, what happens?
You bring in $100, you're only putting up like $30 to hedge it.
That's right.
And if it explodes like it has the last few days,
yes,
or at least Monday and today, then you gave up. You got about a $280 amount of money that will come in to more than cover all your risk on the condor,
which is huge.
And if it doesn't explode, well, you're bringing in like $200 in premium to pay for about $50 of hedging, so you still have $150 left over.
Yeah, and folks, as Daryl goes through these, don't forget every Wednesday, Thursday, 12 to 1 right here. The program's archived. He does an amazing job walking you through these contracts on the Nadex platform. Tomorrow, 12 to 1. Friday, 10 to 11 in the morning. Daryl, have a great night, safe night. Look forward to the show tomorrow.
Hey, man, thank you. You have a great one.
Awesome, man. Stay right there. We're coming right back, folks.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, oil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
If you're like me, you see the world's emerging nations as a very real opportunity, as these countries and their economies are developing right before our eyes. And you can rest assured that Everbank has spotted this opportunity too. In fact, they've just released the second running of their 5-year Market Safe Futures Economy CD. This is a CD that could really deliver, but you only have until June 11th to take advantage. Consider the facts. If the future economy's currencies beat the US dollar over the CD term, you'll get all of the upside at maturity. And should they lose, no worries. There's zero downside risk here, as you get back 100% of your deposited principal. Don't miss out. The June 11th funding deadline is quickly approaching. So hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is an equal housing lender and member FDIC.
Tiger Real Estate Opportunity Fund is currently offering 4-year first mortgages on many of the fully renovated properties that it has purchased. The first mortgages are third-party appraised with a maximum loan-to-value ratio of 70%, providing a secured investment that pays a fixed return of 5% annually, which works out to a monthly income of more than $416 per $100,000 investment with your principal intact and secured. These 4-year first mortgages are perfect for anyone looking for a secured investment that provides monthly income much like a CD. For more information, email tigerfund@tfnn.com or click on the Tiger Real Estate Opportunity Fund banner along the right side of the tfnn.com homepage, or call our office directly at 877-518-9190. There's a limited supply, so act now.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Welcome back, folks. We have the Dow up 241, Nasdaq's up 68, S&Ps are up 25. Market is holding in there. If we go over and we go through these benchmarks, let's take a look at them. So if you start with the SPY, the SPY, this is how this baby is set up right now. We're 211.15, and let's see. This is right there. So it hasn't got over the high that was generated out here where the downdraft occurred, which is on June 4th. So June 4th, folks, we went from 211.89 to 209.75. That would be one of the benchmarks, but on that particular benchmark, what you'd actually need for a failure, you actually have to close under 209.75, and there's no way we're going to do that with 15, 20 minutes left in the marketplace. What could happen if you did a 210.98, which would be down. That's not that far. That's interesting. 210.58 rather. 210.58. What that would get you is that would basically say that you couldn't even hold the high of 2 days ago. So we'll see where that shakes out. We're banging 102 million shares versus 151. So the juice isn't there. We'll see whether they can hold the price coming into the close out here. We take a look at the 3 Qs. Benchmark inside the 3 Qs goes like this. We've done 22 million shares. The 3 Qs, you're talking about 109.21. And what 109.21 is that is the low of the June 4th day. That's where we had come down. You also have the 109.69, which is surprising that they actually can't hold that, because the 109.69 is only 3 days ago. That's where we went sideways. We've hit 109.81, and it hasn't been able to hold the 69. And it looks like when we take a look at this, actually, what you're going to have is, I'll put both of these futures up, that you are going to see a bit of selling coming into this close, and you get 37 minutes. So the thing that's intriguing when you have fast counter-trend bounces like this is that you don't need a large amount of selling to come into the close in order to get a failure. The reason being is that the market itself has only gone to the price point of where it was 4 days ago. That's how it's shaking out right now. Like the futures are 21.04. Bottom line, 21.05 should have been able to hold. If this baby gets into the 02 or lower, then bottom line can't handle it. The NQs, we go over to the NQs and we take a look at the NQs. And this is the amazing part, is that this is the deviance in the marketplace. There's no two ways about it. We take a look at the NQs. Right now, they are at the 44.90 level, and the NQs themselves haven't even made it to the highs of 4 days ago. The highs of 4 days ago, when we take a look at the 5th, folks, that high out there was the 45.06. We got to 44.98. You close under the high spike, the spike would be 44.89. And I expect you are going to close underneath that. I expect what you're going to see some more selling coming into the close. And what is that all about? What that's all about, folks, is they drive it, spike it, keeps it up, and then all of a sudden comes all the way back down. There's a whipsaw that is out there. And what that does, no doubt, is keeps the bulls and bears, okay, both nervous in the marketplace. But that, when you have high volatile markets, which we're in right now, and we're going to be in for a long period of time, the counter trend bounces in a bear market, which my take is that that's where we're at right now, are always vicious. They're fast, they're furious, they're all of the above. We take a look at the IWM, and what is intriguing here is that the IWM, well, here, let's look at the Russell first. The Russell, yeah, the Russell didn't make it either. Amazing. It's amazing that the Russell just can't get up there. But the Russell, that has to do with the commodity stocks. That's what you are looking at out here. Those commodity stocks still can't get out of their own way. Russell right now, the high of the Russell is 1278. We're at 1267. The Russell is coming into the downdraft, which is a monster downdraft, on the 27th. And you're coming into that area, and you are doing that with lighter volume. So it looks like the Russell also is going to have a hard time basically holding price, which is just pretty amazing. Inside the gold market, let's go take a look at Rheingold Resources. So Rheingold Resources, folks, is a good indication, you know, whether these equities can go higher or lower. Now, what Rheingold did out here today is impressive. It was up $1.78, and that's not the point, because Rheingold trades up and down $2 or $3 like nothing. That's how it trades. But we got the volume in the equity also. You get 495,000. So Rheingold's at 72.36. that's saying, hey, guess what? Wrangell's going to go for 78.83. I suspect what we're looking at there is that we're looking at the weakness in the dollar. That's where this whole thing is shaking out. If we go take a look at AEM, an Eco-Eagle, let's pull up AEM. What we have with an Eco-Eagle is up 62 cents. Now, this equity doesn't have enough volume. And this is where we do have diversity inside the marketplace right now. It's higher, but it needs more volume. We're coming into a downdraft that was created out here last February in an Eco-Eagle. Well, all the equities, actually. But in an Eco-Eagle's case, okay, that downdraft was pretty extensive. Now, an Eco-Eagle also has been able to hold highs, and it never went to its last low. The last low on Eco-Eagle was 26. So that's impressive in itself. If we go take a look at Gold Corp, GG, what do we have with Gold Corp out here? Gold Corp today is trading at $17.30. That needs volume also, and we happen to own Gold Corp. You know, what Gold Corp has done is this. We just bought it last week. What Gold Corp has done, you know, you've come off a high of 25 bucks. You're at 17.20. It's rejected the lower price, you know, the lower swing points. What we need now, though, is wide price spread, accelerated volume. After you reject either higher price or lower price, what you're always looking for is a confirmation, and that confirmation, folks, is wide price spread, accelerated volume out of there. Let's say that you have taken out a high, you're taking out with volume. What you're looking for then is you're looking for a backup with lighter volume into the space. Then you know you have two different things. You know you have buyers, wide price spread. You know you have no sellers. Is it backing down? Good situation. When you're going down, as Gold Corp has tested its low, what you're looking for then is a rejection of lower price with lighter volume. Then you're looking for a sign of strength to come inside the marketplace. If we go over to FCX, Freeport McMoran, a little bit different. FCX, I suspect right now, we happen to own this one also, this got a little action going. You know, today, no big deal. It's up 49 cents. You're at 20.54. But what you also have here is that we have three higher lows. You get a high out there that's laying out there at 23 bucks that has some juice underneath it. And they're set up, you know, basically in the marketplace, meaning that huge gold company, huge oil company, huge copper company. The oil market. Now, let's go take a look at oil, because oil is going to be a little tricky here, folks. But I suspect what we're looking at is this. Let's see. CL, we're on the new contract. So we're dealing with Q, I believe. Yeah. CLQ. CLQ5. Okay, so when I brought this up earlier, it wasn't going to have the juice behind it. Yeah, it has the juice behind it now. No, it's not time to sell just yet. Okay, so oil is up a buck. It's 61.64, and you get the juice behind the move. We're 152,000 contracts. That's saying that, you know, it's not a sell at this point. What it did do out here today is that it would be a failure of the June 2nd high, but when you push with volume, you get over a swing and you back down, that's going to go right back up at that level. So that baby's not ready to sell just yet. If we go look inside the commodity market, the biggest move is inside that commodity market. Gasoline, that's up 2.5%. Crude oil's up 1.6. Natural gas is up 1.4. And then diesel is up 1.1. You know, so there's definitely some buying action that is going on inside that oil market. Your divergence out here, folks, and this is not going to stop, has to do with that bond market. That bond market, folks, let me bring this up for you. What I'm going to put is I'm going to put a continuous contract, US1, inside the bond market so you can see how this thing is shaking out. And what it looks like is this. It looks like the market itself has raised the rates, not the Fed. The 30-year has just gone from a price point of 166 to 149. This is an ABC down to 140. You get to 140, and this can go a lot lower after another consolidation. This is Tom O'Brien. This is TFNN. You stay right there, folks. We're coming right back. Dow is up 246. Nasdaq's up 68. S&Ps are up 25. We're going to be right back.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on Tiger TV at TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Tom O'Brien.
Welcome back, folks. Dow right now is up 247. The Nasdaq's up 70. S&Ps are up 26. Leaders out there, folks. You got, let's see, TransCanada, Sun Financial, Canadian Tire, Brookfield, Renewables. Losers out there. There's Regeneron's a big one. Sears Holding, that's down 18%. Sears is getting just absolutely killed. That's a classic, though, no doubt. You get Tesla off $4, no big deal there. Bluebird is down 281. When you do take a look at the Dow stocks, bottom line is not a Dow stock that is in the green out here today. You have IBM up 331. Caterpillar is up 181. You get Citigroup up 101. In fact, let's go take a look and see what we're looking at when we look at the JP Morgan, because what we do have out here is this, which is just pretty amazing, is that when you look at the XLF is up 37 cents today. We hit 25.14, and this is just incredible because it finally hit its high. And the high, check out the folks. This is here. I'll put the XLF up first because this is pretty bizarre. So the XLF hadn't hit its high yet. The high that we're talking about is December 29th, $25.14. And, you know, it's always intriguing, like, how does it work? It hit exactly $25.14 today. Exactly. So on the daily, now, the XLF has some juice behind it. We put this on a weekly, and what you're going to see on the weekly is that you're not even close. On the weekly basis, what you have is that you're dealing with 237 million shares. We're on a Wednesday, and this is going to do all of about 85. So we'll add, 30, 60, 90, add another 60. So your correlation is going to be, did I say 80? 1 second, 80? Okay, 85 and 30. Say we'll do 35. That's $1.40 versus 237 million. Huge. And the drag on that, by the way, and this is what's really wild. I was talking about this morning. The drag on the XLF is Berkshire Hathaway. You know, Berkshire is already at the October 15th swing high, rather. You know, so Berkshire is off the highs of 152. We're at 140. And inside that XLF, that is the largest weighting. We go to the XLE. We look at the energy. Energy, folks, is still large oil, gas entities is still saying it can't get any traction, which is pretty wild. We're at 78.19. That baby wants to run down to the swing low that was established out there in January, which is 71.70. So that, no doubt, has a lot further to go down. That means that you want to keep your eye on the gold, on the oil market big time. If we go take a look at the IYR, now the IYR is the commercial real estate REIT. The IYR right now has gone down. We're at 73. It's gone down from 82, and it's down here with juice. The IYR looks like it's a large, let me see if this is an ABC down. Okay. So if we put this back a little, let's see, I'll put this on a weekly. And what you're going to see is that we're trading where we were trading in August of last year, first off. But what you're also going to see is that you get a high volume spike that this is going to go after. This is going to go after the 70 to 68 area. And that totally makes sense because of the interest rate structure out here. That's how this thing is shaken out. Because commercial real estate, folks, no doubt, will have a really tough time with rates going up. You know, the residential real estate, no doubt, you know, every quarter point rise in a 30-year mortgage, okay, basically brings less buyers into the marketplace because, you know, that's just how it goes. The commercial real estate, however, is much more rate sensitive by a huge amount, too, not in a small amount. And the reason has to do with how they build commercial real estate, how they push the paper out in commercial real estate. In fact, if I suspect most of you get the Wall Street Journal. What you want to do is this. You go into the back, the market, the mercantile market, and the Wall Street Journal. It's only a couple pages that have little ads. What you're going to be looking at is this. You'll see these little ads, 1-inch ads, triple net leases, Walmart triple net, I mean not Walmart, Walgreens triple net leases, CVS triple net leases, bank triple net leases. Go look at those. That is where the market is going to take the biggest tanking. And the reason being is that when they build these malls or small strip shops, what they do is that they package that paper, they move that paper out to get it done, then guess what? What happens is that the paper actually, they're not delta neutral, meaning that they don't have the project finished before they've already got an interest rate differential in it. They've made a fortune in the past 35 years because the market has gone down on interest rate structure. I suspect the first couple of years coming out is going to be really tough. Why? Because if you sold the project, let's picture it when the rates were going down. You sold the project at 4%, let's say. You sold it at 4, you get the paper at 4. By the time that it completed, that's when the whole transaction actually takes place, the second part of it, you're at 3.5. The developer has just made another 0.5%, which in a commercial business is like insane because it's so much money because it's leveraged out. Now picture the other side of it. You're doing a deal. You're doing the deal at 3.5%. Bottom line, you're coming out at 4% on the other end. Guess what? The amount of profit that is sustained inside that development goes down dramatically because percentage-wise, that also is a huge deal. I do expect what you'll see is that, you know, if in fact these rates stay higher, you'll see that texture change a bit, but the cycle between where we are right now and where I suspect we're going to be in another 6, 8, 9 months, that is going to get some taken used to, and that's why you see those commercial real estate equities down. And then, of course, what does happen with the Simons, the SPGs of the world, what that structure itself has to do with yield gross, okay? So SPG, if you take a look at that, SPG is the largest owner of malls in the world. They're paying a 3.4% gross. Well, guess what? 3.4% gross is not going to mean a thing when the stock just came down from 200 to 176. You know, you're going to see that thing get whacked, okay? The bottom line is that, yeah, you can make a gross, but guess what? When you're making dividend payments, you want to be secure in the price you're paying for it. And inside the REIT market, that is not what you have because the principal is going to get whacked, and the principal is not going to make up for the dividend yield that you're going to get. This is Tom O'Brien, this is TFNN. You stay right there, folks. We'll be coming right back.
The following is a presentation of TFNN. The Tom O'Brien Show is produced every business day. Tom takes your phone calls toll free at 1-877-927-6648. Internationally at 727-445-1044.
Let's go to Nick in Tampa. Hey, Nick, what's going on?
Tom O'Brien, it is an absolute pleasure.
Thanks so much, man. We appreciate you calling.
No problem. Dude, I've been listening to your show for about 2 years now, and it has just been wonderful. I listen to you, Basil, Andy. You guys do an amazing job.
Well, thank you so much. We appreciate you growling and prowling out here with us.
Now, Tom O'Brien.
Welcome, folks. This is Tom O'Brien of TFNN. We go 5 days a week. We go 10 hours a day. We go 24 hours a day on the internet at TFNN.com. Always remember, folks, whatever you think about, you bring about. Whatever you focus on grows. Hope everyone's having a great day, safe day. Let's make it a great night, folks. This quote is by Norman Vincent Peale. Never talk defeat. Use word like hope, belief, faith, and victory. Market-wise, let's take a look at it out here. We had the Dow Industrials finished up 236. NASDAQ up 62. S&P's up 25. Gold contract up $7.40, trading at $1,185 an ounce. Silver flat at $15.96. Platinum up $6 at $1,113 an ounce. Copper up 2.5 pennies at $2.74 a pound. Light sweet crude up $1 at $61.60 a barrel. Bonds continue to get smacked. You had the 10-year down 16 ticks, 124.19. 30-year off a full point and 12 ticks, 147.24. And King Dollar down 577 ticks at 94.59. What King Dollar did, folks, is take out a small swing point with volume. It's a small ABC structure on the way down. It's going after its largest swing. You know, we'll see if it can basically take that largest swing out, which is about another penny below where we are right now. I do expect it's going to go after it, and it doesn't need a lot of volume. We did about 80,000 contracts today in the dollar. It only needs 56,000 contracts, taking that B point out. Euro up 43 at 113.26. The yen is off a penny and a half at 122.64. Our phone number is 877-927-6648. Give us a call, folks. Want to know what's going on in your world? In the world of the S&Ps, let's take a look at them. What do you got? We get a bounce, no doubt. Volume-wise, the volume's not bad out here either, folks. It's lighter than we had on the way down. Bottom line, there's 128 million shares in the NYSE. You're going against 151. We're at 210.96. You know, we'll see whether it can basically get up to the 211.85. The high in the S&P right now is 213.78. What we do have, and this is the larger aspect of it, we're on the cash S&P, you're at 2106. The cash S&P, folks, has to get over 2119. That's not the high, that's the benchmark. The low of that high is 2109.89, so we haven't got to the low of the high yet. NDX 100. What do we have with the NDX 100? This is what you're looking at. If we look at the three Qs. The Qs today, we're up on 27 million shares. You're at 109.49. And what the Qs did, they actually failed. Now, this one's going to be the real interesting one. This is why. So, NDX 100, we use the three Qs. They went into the downdraft from the 4th of June. That bottom of that downdraft is 109.21. They got over the high of only 3 days ago, of Monday. That high is 109.69. Bottom line, they couldn't even hold 109.69. That just is a dead cat bounce. That's what this is set up as. So we'll see how this baby shaked out. We go take a look at the gold market. What we have with gold is this. Gold held price. What? We're at a price point right now. GCQ5. Gold is trading at 1185. It's in the higher range. As soon as it got back inside this 1180 basically to 1183.90, that keeps it in the higher range. I do want to see more volume on gold. You get an expansion of volume out here today. The way that it is set up is that, look, it wants to get up to this 1232 price point. We have divergence in that market, however, and the divergence being how the gold and silver equities are acting. A few of them are not bad. Rango Resources is not bad. A couple others need some strength behind the moves. Bond market, bonds are going down on price, up on yield. Right now, the 10-year is trading at 2.484. That's in the 10-year, the 20-year, the 30-year, the 5-year, and 5-year note, they're all in ABC structures on the way down, folks. If you take a look at the TLT is at 115.52. Bottom line, straight line move. It broke the B point, broke it with volume. And what that sets up is that what you're going to see is that the market itself versus the Fed, the market itself is actually raising the rates, doing the Fed's job. We go take a look at the high vol here. inside the Dow Industrials, as to what was moving things out here today, inside the Dow, folks, there wasn't one stock that was red. Visa was leading the charge. That was up $1.67. Microsoft was next, up 96. Caterpillar was up $1.75. Goldman was up $4. The weakest stock inside the Dow Industrials today out here was Walmart. That was up 46 cents. Inside the NDX 100, what was leading the charge inside the NDX 100? You had Alexa Pharmaceutical. That was up $10.84. Netflix was coming up next at $23. Netflix, man, you talk about volatility. Netflix opened at $6.53. Now, they had their shareholder meeting last night, and what they did, they didn't put in place a split. What they did put in place is that they authorized more shares to be issued. That is a precursor to a split. Netflix was up as high as $6.92, gave back 20 points, still is up 23 points. ADI, let's see. Analog Devices was up $2.03, that's 67, and Intuit Software was up $2.84. Taken away from it on the way down, Regeneron, that got whacked. That was down $13, had been down $23. Tesla was off $5.60. NVIDIA was down $39, and Vodafone, actually, that was it. So that's interesting. So when I just gave you the NDX 100 also, what you had there is that inside the NDX 100, this is pretty wild. So check this out. Inside the NDX 100, what you also have is that, because Vodafone was positive, is that there were only 3 stocks that were in the, there's only 3 stocks out of 100. That's pretty intense. So when you take that context also, that there were only 3 stocks inside the NDX 100, bottom line, we should have went up a lot higher. XAU, the HUI. Let's take a look at the XAU and the HUI. XAU out here trading at a price point of 68.47. What we have inside the XAU is this. It got as high as 68.96. Yeah, it didn't give back much. It's not bad. 68.96. We want to see that stay inside the 67.93 area. So right now, that's still inside a higher range. What this doesn't have right now is that it really hasn't broken the downtrend that was established out here from May 14th. May 14th, we went from $77, and you get down to 68. If we go take a look at the HUI, the Gold Bugs Index, and this is where the differential comes in the marketplace right now, too, I suspect. The Gold Bugs Index is trading out at 160.52. That's just, excuse me, folks, that needs wide price spread and accelerated volume also. That really hasn't broken the downtrend from that 186.95, where some of the individual equities have broke it, and they not only broke it, but they broke it with some good juice. If we go over to Rheingold Resources, we take a look at Rheingold. Rheingold's one of them, GOLD. Rheingold today, we're trading out at the price point of, was up $1.84. It did 587,000 shares. That's much more than we came down on. We came down, we came down on 639. It's still not bad. We did 587. That trend is broken, meaning Rheingold wants to make that run for $78.90. That's the way that is set up right now. Many of the transports out here had a dead cat bounce. The transportation index itself was up $56. We're at 83.63 right now. And the transport index, folks, is the one you want to continue to just keep your eye on, because if we go look at Delta, if you look at United Pacific, if you look at these rails as well as the airlines, you're going to see they're coming in for not only a rough landing, they're already down big time, but they're going after the October 2014 swing low. United Pacific has already hit it. Delta is a few points away from it. This is Tom O'Brien. This is TFNN. You stay right there, folks. Come right back. Dow finished up 236. NASDAQ up 62. S&P's up 26. We're going to be right back. If you're like me, you see the world's emerging nations as a very real opportunity, as these countries and their economies are developing right before our eyes. And you can rest assured that Everbank has spotted this opportunity too. In fact, they have just released the second running of their 5-year Market Safe Futures Economy CD. This is a CD that could really deliver, but you only have until June 11th to take advantage. Consider the facts. If the future economy's currencies beat the US dollar over the CD term, you'll get all of the upside at maturity. And should they lose, no worries. There's zero downside risk here, as you get back 100% of your deposited principal. Don't miss out. The June 11th funding deadline is quickly approaching. So hurry over to everbank.com/TFNN-CD for more information, including important product details and disclosures. Once again, that's everbank.com/TFNN-CD. Everbank is an equal housing lender and member FDIC.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Welcome back, folks. 877-927-6648. Give us a call, folks. We know what's going on in your world. Now, the world of corporate bonds, folks, you got to check this out, okay? I'm going to read you clips from this article because this is pretty cool. So the headline of the article is, a $3 trillion traffic jam is seen looming in credit by Citigroup. For all the concern that Wall Street's shrinking balance sheets will fuel a liquidity crisis when investors flee credit markets, Citigroup strategists say investors may be overlooking an even bigger catalyst. The size of the U.S. corporate bond market has ballooned by, this is amazing, by $3.7 trillion in the last 10 years. Yet almost all of that growth is concentrated in the hands of 3 types of buyers: mutual funds, foreign investors and insurance companies. Now, the foreign investors, folks, will be foreign central banks. They like buying it, according to Citigroup. That combination could lead to more selling than the market can absorb when the Federal Reserve raises interest rates for the first time since 2006. All the money is going to the same place, and when something adversely impacts one, chances are the same factor adversely impacts everyone else. And there's no one to take the other side of the trade. We used to have 23 types of investors in the marketplace. Now we have 3. The 3 investor groups hold almost, this is a crazy number. The 3 investor groups hold almost 2/3 of the total corporate debt, Citigroup data shows. Mutual funds, which are forced to sell when investors redeem for cash, grew the fastest, more than doubling their share to 22% in 10 years. Overseas investors now hold almost a quarter of the market, Wells Fargo's analysts warned last month. Those buyers may be prompted to exit if the dollar weakened at the same time that bond yields rose. The thing that's amazing is that that's what's happening with the dollar, but the reality is that when bond yields rise, folks, the dollar actually should go up, but that is not what's going on. Hedge funds, government pension funds, and security brokers are among the 20 other groups that hold 37%. Dealer inventory of the corporate bonds plunged more than 76% in the years after the financial crisis, as tougher banking regulations made it more expensive for them to hold it. The low levels of dealer balance sheets suggest that dealers will not be making an offer to purchase offset the selling flows. Now, that statement there, folks, let me tell you something. So we're not talking a treasury market here. We're talking about a corporate bond market. Now, a corporate bond market, folks, the bond traders make the most amount of money on Wall Street. Why? Because it's not transparent, okay? When these large funds are either buying or selling bonds, they don't know where the bonds are. The spreads are always wide. What happens is like any other type of product. Someone will always sell it to you. The buying back of that is always a problem. It's always been a problem inside the corporate market. You know, this statement here that on the dealer sheet that there is not enough cash to buy it back, that's true, no doubt about that. But what's also true is that when the bond market tanks, the dealers back off anyway. There was a massacre in, I think it was 94. It was fast, it was furious on the way down, you know, for the bond market. You know, bonds going down 5%, 8%, 10%. Bond buyers don't expect that. So New York Life, check this out. New York Life investment arm, which oversees $215 billion in policyholder money, during a taper tantrum of 2013, bonds went down at 5% in 2 months, okay? Bottom line is that they're not, well, they're making on corporate bonds maybe about 6.5%, 7%. It's wiped out in 2 months. What MetLife says is that they thought that was exaggerated and they wouldn't mind stepping in the future as that's going down. So check this number out. This is amazing. Since 2009, there's been $9.3 trillion in bonds issued. The yields on investment-grade corporate bonds reached a low of 2.65 in 2013. Right now, we are at 3.36. Bottom line, folks, is that it's going to be the corporate bond market, no doubt, that is going to be a problem. So watch how this shakes out. And it's going to be, it absolutely makes no sense that you have 3 groups that own the largest part of the corporate bond market. Where it's going to be, and this is a phenomena that you can track, it's going to be the ETF structure and the mutual fund structure. And this is why. If I remember, you talk about how markets move. The first ETF structures, so check this out. I mean, now we're just used to ETFs all over the place, okay? The first time that the Americans, they used to just trade at the American Stock Exchange, you know, that was it. And I remember when they came out with the 3 Qs, I had the vice president of the American Stock Exchange that day that they came out. And he was telling us what they're all about, what he thought was going to happen. Bottom line is that they exploded from that point on. This is going back to 94, I think. So as they kept adding ETF structures on, it's great when they're going up, okay? Now, the 3Qs, the SPYs, the diamonds, you know, that's diversified across all stocks, right? That structure there, it was great when markets are going up. When markets start going south in 1999, what you had happen, this is where the chicken and the egg come. If you sold Intel, Microsoft, the Qs went down. Qs went down, the sponsor of the Qs had to sell more Qs. They sell more Qs, guess what? Those 100 stocks have to get sold. Dangerous in a huge way. Awesome on the way up, dangerous on the way down. When the gold market starts going back up, you got to remember the GLD wasn't even around when we started the gold report. Gold report started in 2001. GLD started in 2003, I believe. I knew when I saw it coming in, I said, this is going to be awesome. They're going to buy the gold because I'm going right back to the Qs, how the Qs work. Well, bottom line, they had to buy the gold, runs gold all up to 1900. Guess what? When the top comes in and you're going to sell it, what happens there? What happens there, folks, is just the opposite. Whether you're selling the futures go down, the GLD physical has to be sold. That turnaround, I suspect that turnaround, you know, came, but you got going down for 2.5 years. Now let's go to the bond market. This is just like the gold market. This is so dangerous, it's unbelievable, and this is why. So the structure inside the ETF structures, when you have multiple weightings of equities, smooths it out somewhat, but still problematic. Inside this ETF structure for corporate bonds, there's no such thing. What ends up happening? They're trying to get out of the marketplace, and in this particular case, reading this article, you can see that a third has to do with the ETF structure, has to do with the mutual fund structure. What you'll see there, what will end up happening, as rates go up, it's a normal deal, too, by the way. As rates go up, folks, what ends up happening, people want to buy new bonds. They don't want the old bonds, because the old bonds, you're stuck with them, and you're getting a smaller interest rate. Inside the ETF structure, what you're going to have, they're going to sell them down. As they sell them down, guess what happens? No one's on the other side of the deal. It's going to be a huge problem, and we'll see how that rocks markets. But if you are in this bond market, the only type of bonds that you should be holding right now are treasuries that you know you're going to get paid for, that you're not going to sell, because treasuries will also go down. You're not going to sell them. You're going to get, you bought them, you get the coupon. You want corporates that you're going to keep? Great, no problem. Bond funds, get out of them, folks. Get out of them right now. This is Tom O'Brien. This is TFNN. You stay right there, folks. We're going to be coming back with someone that knows a lot about not only the currency markets, but the money markets. We're going to have our man, Mr. Chris Gaffney, the president of Everbank World Markets. We're going to be right back, folks. You stay right there.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns as well as market trend calls. markets. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. Tiger Real Estate Opportunity Fund is currently offering 4-year first mortgages on many of the fully renovated properties that it has purchased. The first mortgages are third-party appraised with a maximum loan-to-value ratio of 70%, providing a secured investment that pays a fixed return of 5% annually, which works out to a monthly income of more than $416 per $100,000 investment with your principal intact and secured. These 4-year first mortgages are perfect for anyone looking for a secured investment that provides monthly income much like a CD. For more information, email tigerfund@tfnn.com or click on the Tiger Real Estate Opportunity Fund banner along the right side of the TFNN.com homepage, or call our office directly at 877-518-9190. There's a limited supply, so act now.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Welcome back, folks. We had the Dow finished up 236. NASDAQ was up 62. S&Ps are off up 25. And we're going to go over to our man, Mr. Chris Gaffney. Chris, folks, of course, many of you have heard him before on TFNN. He's the president of Everbank World Markets. As you come over to our website at TFNN, you can see the Everbank banner on the right-hand side. You can hit that banner, or you can just go to everbank.com/TFNN. And when you do that, folks, what you're going to want to hit is hit investing. And as you hit investing, what I'd like you to hit is market-safe CDs. And Everbank, folks, is on the cutting edge of basically rewarding investors, rewarding folks that want to get safe investments. And safe is, you know, a word that I don't use a lot in the marketplace. But the bottom line is that they've put together a CD. And the way this CD works, okay, I'm going to let Chris explain it, but it's a very unique way that this works. And in this particular case, it's only $1,500 to open. You get 100% protection of your principal. There's no account fee, monthly account fee. It is FDIC insured, and it's IRA eligible. Chris Gaffney, welcome back to TFNN.
Thanks, Tom. I always love being on your show.
I'll tell you, you know what's so cool, man? And I remember, the first time that EverBank itself, came out with a unique product. I was looking at it, I says, man, this is really unique what a bank is actually doing. I'm going back years ago now, okay? But you seem to come up with some products that are just really great in the aspect that as an investor, you're always thinking, I don't want to lose money, right? I never really think about how much I'm going to make because I've been doing this too long. So I always think, okay, what can I lose? You know what I mean?
Well, and that's the key to, keeping your investment portfolio, earning is not to lose money. That's absolutely the key, and it's tough in some of these volatile markets to be able to participate in those markets and keep your head above water still, because as you know, the swings can be pretty dramatic and can come at times that are inopportune for the investor. So, and I wanted to use this time to we do have a market safe. If they go out to the market safe page right now, you'll see an existing market safe that we have in place, but the funding deadline for that existing market safe is tomorrow, and then tomorrow, and your listeners are going to be the first to hear about it. Tomorrow we're announcing a new and what I think is a very exciting product, and it's a market safe that's going to be based on metals. And I know that you're a big fan of diversification into metals and the metals markets, and we've finally been able to come out with a market safe that we're calling the Power Metals Market Safe CD.
That is absolutely fabulous. So what happens with these market safe CDs, folks, okay, is that if we'll just stick with the one so you have until tomorrow to fund this, folks. And the phone number would be 855-750-4051. This one is based on the growing economies of China, Brazil, India, Indonesia, Mexico, and Turkey. It's one index, okay? They merge it as one CD index. Now, what's really cool, can you just explain to them that, if in fact the index beats the dollar, that they get a 10% upside?
Right. That's the Future Economies CD that's out there right now that the funding deadline is tomorrow, is based on those 6 different currencies. And we have what we call a jump note on that market safe, meaning that if those currencies perform positive, and again, if those currencies return is at all positive,
yes,
we're going to pay 10%. So even if they just go up on average 1% over the 5-year term, the investor, the depositor, is going to receive a 10% return, so their principal plus 10%. So that's our jump note structure. Now, if the currencies perform better than 10%, they're going to get that too. So you're not capped out at 10%. It'll jump all the way up above. If the currencies perform 20%, you're going to get the 20% return plus your principal. So it's a what we call a jump note. Again, if the currencies go negative, if the dollar stays strong and for some reason these currencies do not, on average, perform in a positive fashion against the dollar, then the depositor will get their original deposit back. So
how cool is that?
It is a risk-free investment, a risk-free way to get exposure into the emerging markets.
Now, first off, I want to thank you from all the listeners, all the tigers and tigresses, for, turning us on to the new one that's coming out, because there's no doubt between the gold market, the silver market, the commodity market in general, we have a lot of listeners out there that are in that market. So can you just give us a few other...
I'll give you a sneak peek of it.
Awesome.
It's going to be
great.
It's going to be a 5-year term again.
Yes.
It's going to be based off gold, silver, and copper.
Okay.
It's going to have an annual look back, so it's going to have annual pricing, annual averaging. So each year at the pricing date, we're going to look at the performance of each of those metals. Now, on an annual basis, that performance is going to be capped out at 45%.
Okay.
So each year, if the metal goes up less than 45%, that's the percentage that we're going to use to calculate the overall return. If it's greater than 45%, if gold should go up 50% next year, we're going to cap that out at 45%. But ultimately, at the end of the 5-year term, we're going to average all those annual pricings out, and that's what we're going to pay to the client. So again, it's a market-safe CD, meaning there's no risk to the principal. If metals should, for some reason, drop during this 5-year period, the clients will receive their original deposited principal back.
Now, you know what's so cool here? I mean, metals, of course, we had extraordinary run, 2002 going all the way up, hitting this high out here in 2011. Mm-hmm. So it's pretty neat that you're doing this when, my take is that, basically we're at much lower prices. So my take on it is that metals want to go up, but, we'll see where this goes. But it's sweet that it's at a lower price right now.
And I want to use past performance obviously is no guarantee of future returns. However, I want to use as an example, we just had a market-safe mature, a diversified metals market-safe mature that we issued back in May of 2010.
Yes.
And so it was a 5-year CD that was based on this one was based on gold, silver, and platinum. So it was 3 different metals.
Yeah.
But that CD ended up returning for the clients, and I'm pulling up the data on it right now, up over 21%. So that one had a upside payment of over 21% during that 5-year period. And why I wanted to bring it up is those investors that invested back in May of 2010, when it matured, those metals were actually at a price lower than the original investment point. So if they had invested directly into the metals, they would have had losses. But because of the averaging that we used on the market safe, they actually ended up with a 21% return. And kind of the best of both worlds, if you would, they booked the return, and then they were able to buy back into the metals at lower prices than they originally invested.
It's amazing, because I think the last time you were on, that's when that thing was mature, and the month before that. And it's so cool, folks. And if you're watching, Tiger TV right now, I have, the gold chart up, and this is dramatic because it just as Chris said, in May of 2010 here, you're talking about gold was $12.49. It goes all the way up to a price point of $19.20. Okay, comes all the way back down, but yet the investor actually made money, and it has to do with that repricing every year, which is really cool because that's almost like, what do you lock it in every year? Is that how that works?
Right. You're locking in that performance on a yearly basis, and then taking the average of those. And I tell you, Tom, as you know, if clients, if a client thinks that, if an investor thinks that metals are just going to go through the roof and are going to go to skyrocket, and don't think that they're going to fall, then perhaps an investment directly into that metal is fine. We've got a couple different ways for investors to invest into the precious metals accounts directly, and maybe that's a better investment for those folks. But for those individuals who feel like they don't want that volatility and they don't feel like they can time the markets, something like our market safe is really ideally suited to them.
Absolutely. And folks, just know every day right here at TFNN, you can see that banner on the right-hand side. Their phone number is 855-750-4051, and we'll make sure exactly when that baby comes out. Chris, thank you so much. You have a great night, safe night, and look forward to speaking to you again.
Thanks, Tom.
Okay, have a great one. Have a safe one. It's everbank.com, folks, /TFNN. So you have 2 different choices there. You can you have the second chance to brighten your future with the 5-year Market Safe Futures Economy CD. You want to wait a bit, meaning I believe it's going to be coming out in the next few days, next week. That's going to be the Metals Safe Market Safe CD. This is Tom O'Brien. This is TFNN. You stay right there, folks. We'll be coming right back. Dow Industrials finished up 236, NASDAQ up 62, S&P's up 25. We're going to be right back, folks.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartleys, ABCs, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. TFNN has just announced a brand new morning lineup that is geared specifically for traders in this volatile traders market. Every morning at 8 a.m., John Logan starts things off with his daily program, The Global Market Pulse. At 9 a.m., Larry Pesavento trades the market during the market open Monday through Friday on Trade What You See. At 10 a.m., Tom O'Brien hosts the Money Masters for the hour, and Basil Chapman hosts his Tiger Technicians Hour at 11 a.m. From 8 a.m. till noon every market day, these traders are with you as they provide up-to-the-second market information so that you can make the most educated and profitable trades possible. The new TFNN morning lineup is happening right now. Tune in to see for yourself what kind of actionable trading discussion they have each morning, Monday through Friday, starting at 8 a.m., live only on Tiger TV at TFNN.com.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Tom O'Brien.
Welcome back, folks. Now, let's go overseas, folks. We're going to take a look at overseas because what we had overseas last night is that we'll start with Hang Seng. And, you know, these markets have gone to the moon. Bottom line is that last night, guess what? They came, they not necessarily came back to earth, but the Hang Seng in general, this is how this baby had shaken out. So the Hang Seng, folks, March 13th was at 23,000. It blasted up to 28,000. So, you know, up 5,000 points in about 2 weeks. Now, it came back to earth, and as it's coming back to earth, what you're seeing is that, let me put this back on a monthly first. Okay, so what you have is this. The high of the Hang Seng in 07 is 31,000. This blast off took it up to 28. Now, this is going to come back into the 24,900 where it broke out from. It's really going to be crucial to keep our eye on this and see, okay, as it comes back in, does it come back in with lighter volume? Because if it does come back in with lighter volume, what that's going to set up a run up to the highs inside that Hang Seng index. Now, let's go to Shanghai, because Shanghai is the absolute rocket ship. Shanghai, that's also going after its highs. And then I'm going to, oh, 1 second, there she is. The highs that we're talking about in Shanghai are the, there she is. Okay, so we're talking the 2007 highs. Shanghai is on a non-stop route. Shanghai has just gone, in the last 4 months, from 3,000 to 5,100. Now, we take a look at this and we see where this is at. Shanghai, the high is 61.24. When you go up this far, Shanghai is going to basically get to that point. The key in this move topside will be the sustainability of it, number one, and does it fail, and how fast can it come back? Thus far, this is what you have. As we climb higher, and it's parabolic, the amount of volume is dropping dramatically. So check this out. 3 months ago, we did 1.2 trillion, with the T. Last month, 1 trillion. This month, we're at 500 million right now. Bottom line is that I expect you're going to get up there, number one. The real key is going to be, how do we get up there, and then how do we basically, does it break it? Does it fall out of bed? What does it do? I can tell you that the last time that we did this, and I remember this so well, the markets are never the same. They're the same, but always a little bit different. So Shanghai last time when it took off, folks, this was just a crazy move. It was crawling up from 2005 to about 2006. In 2006, November, it was at 1,800. It didn't stop. It went from 1,800 to 6,100 in 12 months. One way, too. One-way deal. Well, when that happens, what ended up happening next? Guess what? It went from 5,600 in 13 months all the way down to 60, 66, 64 again. We'll see how this sets up. What's important to wrap your head around on this exchange is this, is that we have a lot of equities that are trading in our markets on this exchange. You know, how that operates, how that pulls back is going to be important for our own markets. What I expect we're going to see, though, when I take a look at the summer, when I take a look at the fall, where I expect the pressure to come in and into our own markets is our own bond market. It's not even the context. I don't think the Fed is going to turn around and move off zero. But our own bonds, the supply versus the demand, are moving the rates off zero. So the Fed, it will be easier for the Fed to basically go from 0 to 2.25. But when you also look at that, it's like, does that mean anything? Psychologically, it means something. But it certainly doesn't mean anything for you and I, because what ends up happening, the only people that can get zero rates or 0.25 rates are the banks. Other than that, interest rates really, you know, basically CD-wise, yeah, they're not out there. What you have is that the structure itself, I suspect, is going to go higher. Bonds are going to go higher. Now, I don't see huge amounts, but if you do need a mortgage out there, go get it right now, folks, or go refinance right now, because the 10-year is at 2.48. That 10-year looks like it's going to run into 2.7. 2.7 is going to generate about a 4.1, 4.2 in the 30-year. And the 30-year, when this get-go in the last 3 or 4 months, had gone down, you know, to about a 3.75, 3.65. And I wouldn't, let's put it this way, get a 15-year. I hear many people say you want a 15-year. It makes no sense, folks. Money is cheap. And you want to get the cheapest amount, the most amount of money at the least expensive price for the longest amount of time. The reason is then you can make the decision. You get extra money, you don't want a bill, pay it off. The difference is that you have the control mechanisms then versus signing a contract, meaning a mortgage, with a bank or an entity that it's a 15-year deal when, in fact, if in fact rates crawl up, and you got to remember something, from 81 to 2015, we went from a 14.5% Treasury to a 0.25 Treasury. That's what a bull market's all about. Well, that's extraordinary. I've never seen anything like that. I don't think anyone's ever seen anything like that. What on the other side of it? Where can you go on the other side? There's only one way to go, and that one way, folks, is up. Now, I don't expect that rates are going to go up dramatically. The reason being is that there's so much cash running around. There's so much cash, it's unbelievable. People are still scared. They just want to be able to get their money back, and you can't blame them. After the downdraft, after the volatility, I suspect that what we also have happening here is that after the amount of large broker-dealers, large banks, the large international banks, you know, they get finished with one crisis and paying off fines. They go from one crisis to the next crisis. Do you know what the next crisis is going to be, folks? Not crisis, but where the banks are going to get fined. The banks have just finished basically paying off for fixing the foreign interest rate. I mean, the interest rate structure, right? The currencies. Well, what's going to probably happen next is that now the Justice Department is coming into them for the Treasury market. And you know what? I think there's 5 primary dealers. They're going to get grabbed there, too. They're going to get there because, you know why? Because it's been done over the course of so many years that these large banks have really got lackadaisical over the course of years. The amount of money that has been made, you know, but bottom line, guess what? You can't fix markets, and that's what they've been doing. Always remember, folks, whatever you think about, you bring about. Whatever you focus on grows. And whatever you want in life, folks, visualize it like a nice big motion picture. Step into it, take ownership of it, and fly with it. Thanks for being here, folks. Have a great night, safe night. Look forward to speaking to you right back here tomorrow morning. Wow! Go get them, folks.